When the clock struck midnight on December 31st, 2007, little did we know what the coming year held in store. The world was on the brink of an economic meltdown, the likes of which hadn't been seen since the Great Depression. The year 2008 was a seismic shock that rippled across the globe, shaking the very foundations of the financial world. The epicenter of this financial earthquake, the mortgage industry, the trigger, an over-reliance on subprime mortgages, loans given to borrowers with lower credit ratings, a risk glossed over by the intoxicating allure of high returns. As the year unfolded, the truth began to unravel. The housing bubble, inflated by these risky mortgages, burst spectacularly. Major financial institutions, once thought invincible, teetered on the brink of collapse. Lehman Brothers, a titan of Wall Street, crumbled under the weight of its own debt, sending shockwaves across the financial world. The fallout was swift and brutal. Millions of homeowners found themselves trapped in a vicious cycle of negative equity and foreclosure. The dream of homeownership turned into a nightmare for many, as their most significant investment turned into their biggest liability. The ripple effects spread far beyond the housing market. Retirement savings evaporated, jobs disappeared, and trust in the financial system was shattered. The world economy plunged into a deep and painful recession, the effects of which are still felt today. But it wasn't just the economy that suffered. The psychological impact was profound. The crisis exposed the fragility of the financial system and the dangers of unchecked risk-taking. It forced us to question our understanding of risk, the role of financial institutions, and the very nature of the economy itself. The over-reliance on subprime mortgages and the subsequent collapse of several major financial institutions served as a stark reminder that the pursuit of profit should not overshadow the need for prudence. As the dust settled, we were left with a mortgage industry in ruins and a world forever changed. In the aftermath of the crisis, a phoenix rose from the ashes. The mortgage industry had to evolve or die, and evolve it did. Post-2008, the mortgage industry underwent a metamorphosis. A new era began, marked by tighter lending standards. Banks became more cautious, scrutinizing borrowers with an eagle's eye to ensure they could, indeed, afford the loans they sought. This made for a safer financial environment, but also one that was less forgiving for those with less than stellar financial histories. Then there was the rise of the global, systemically important banks, or GSIBs. These financial behemoths increased their capital significantly, serving as a buffer against potential losses. This was a game changer, making banks more resilient and reducing the risk of another financial crisis. Another significant shift was the standardization of derivative valuation and the collateral process. Before 2008, the derivative market was like the Wild West, with different players valuing derivatives in their own way. Post-crisis standardization brought more transparency and consistency, making the market more reliable and less prone to shocks. But perhaps one of the most notable changes was the replacement of LIBOR with trade-based SOFR. LIBOR, the London Interbank Offered Rate, was widely used as a benchmark for short-term interest rates. However, it was plagued with problems, including manipulation scandals. The Secured Overnight Financing Rate, or SOFR, offered a more reliable and transparent alternative, becoming the new standard. These changes marked a new chapter in the mortgage industry's story. The industry had been forced to adapt, to learn from its mistakes, and to rise from the ashes. It had become a more reliable, more transparent, and safer place for borrowers and lenders alike. But as we moved into the year 2023, a new challenge arose. Mortgage spreads over treasuries jumped to nearly 2%. This was a wake-up call, a reminder that despite all the changes, risks still remained. The industry had learned its lesson, or had it? Fast forward to 2023, and the mortgage market is worth nearly $11 trillion. But half of these mortgages are originated outside of the banking system, a new risk emerging on the horizon. Let's take a moment and let that sink in. Half of the mortgages in this colossal market are being processed beyond the traditional banking system. This shift presents an intriguing challenge. The mortgage production process, inherently fraught with risk, has seen a dramatic transformation. Mortgage pools are now sold forward as to be announced, or TBA, contracts. These changes have not been without their consequences. In May of 2023, mortgage spreads over treasuries made a leap to nearly 2%. This jump indicates a heightened level of risk in the mortgage market. However, every challenge presents an opportunity. In response to these developments, the CME Group launched TBA Futures. These financial instruments are designed to provide risk management tools for the fluctuating mortgage market. The growth of TBA Futures has been swift, a testament to the robust demand for better risk management tools. As the mortgage market continues to navigate these uncharted waters, the Treasury market provides a beacon of stability. The Treasury market's symbiotic structure allows participants to invest in Treasuries while managing risk with futures. It's a model that the U.S. mortgage market might one day mirror. The mortgage market continues to evolve, its future uncertain and fascinating in equal measure. The world of finance is a complex labyrinth, and navigating it can be daunting. But fear not, we're here to guide you through the twists and turns. Your engagement is what fuels us. It's your comments, your likes, your shares that motivate us to dig deeper and explore further. So don't hold back. Let's create a vibrant community where we can all learn and grow. We invite you to subscribe, share your thoughts, and join us on this intriguing journey. Join us in unraveling the intricacies of the financial world. Subscribe and comment below to continue the conversation. Together, we can demystify finance.